Yes, yes. Very good morning to all.
Good morning, sir.
Good morning, sir.
Yes, yes, yes.
Sir, what is impaired capital?
That will be covered in module B.
Unimpaired and impaired capital.
See, there is, if there is a loss has not been written off, that has to be reduced from the capital. So that is then, to that extent, there is an impairment in the capital. That is what technically, for your examination purpose, there will be not much distinction. But if loss is unabsorbed or is still carried over in the balance sheet, that is okay. So to that extent, it's called an impairment. That you will have to take care. Okay, 9:30. Once again, Ju, can I start? Good morning, everybody.
Sir, good morning, sir.
Morning,
Sir,
sir.
sectorial caps, sir.
Good morning, sir.
India largely reduced sectorial caps. What is the meaning of sectorial cap on the?
Sectoral cap, yesterday somebody posted actually. There is a sectoral cap that your exposure to capital markets should not exceed certain percentage of your capital as a bank. If you invest in equity, if you invest in unlisted debentures, everything put together, exposures to capital market. That's a topic altogether in APM as well as in module B. So at that time, you will know what it is. For example, I am saying, and then each bank has to have from its own risk management risk management committee to the board. They will recommend to the board and board will approve individual sectoral caps, say to housing sector, to chemicals sector, to steel, like that individually banks will apply. So that will also come under these things. And then if the government of India has put certain things like for defense, you have to have certain kind of investment only or insurance sector. These will be things where this sectoral caps will apply from the government's angle. Insurance, up to 74% they brought it. Still, there is not much money coming in. Now they have, I think, removed that cap also. These are all some of the sectoral cap adjustments. Okay, today not much time left with me because we are very, very slow yesterday. So I will straight away go into the presentation. Yes. So yesterday we discussed about the structure of any bank treasury, like a front office, mid office, and a back office, what all functions they carry out. Questions will come on the role of each of the, functional role of each of the divisions, and then you should be clear what somebody is doing. I have already given a slide. Then we discussed about the segregation of market based on tenor. Up to 1 year is called money market, and then beyond 1 year, residual tenor, not contractual tenor. Residual tenor is called term money, debt market. And then in the money market, we looked at unsecured instruments like overnight call, then notice money up to 14 days, and then beyond 14 days and less than 1 year term money. Then we looked at two other unsecured instruments, CDs and CPs. CDs issued by banks and CPs issued by companies or trusts and other societies with minimum net worth of 100 crores. And then they are both unsecured and negotiable instruments in character. So those things will apply, whatever questions could come on that. And then we also looked at how to overcome this counterparty limit, unavailability of counterparty limit for unsecured borrowings by a weak bank by going in for a securitized form of borrowing, which is called a pledging of government securities for 1 day or 14 days or even longer under the reverse repo mechanism. It is a mirror image when the lender is doing a repo, the borrower is doing a reverse repo. That's all. So have that RBI in mind. And now what is this liquidity adjustment facility which RBI operates on a daily basis to ensure that from the earlier days call money does not shoot up to 100% or 120% or does not come down to 0.25%. Both swings we have seen earlier. With the liquidity corridor being maintained by RBI, we now see the liquidity adjustment facility in operation. We will examine it one by one so that you are clear what these terms corridor and what other terms like infusion of liquidity and withdrawal of liquidity mean from a dual intervention angle of the regulator, Reserve Bank of India. Okay. Now, the reverse repo rate RBI has not changed for long. It still remains at 3.35%. And reverse repo means RBI is doing the reverse repo. Be very clear on that. Who does it? We always talk in terms of RBI for these two terms. And between two market participants, lender of money will do a repo and borrower of money will do a reverse repo. Yes. So here, whichever bank is surplus with money and they don't want to lend it in an unsecured form in call money, or they have already exhausted the limit as maximum lending permissible in call money for any scheduled commercial bank. Yesterday we discussed probable question.
Sir, it's the 10 million or maximum the capital.
One capital.
100% of capital.
That is maximum foreign currency borrowing. My question is, how much is the maximum call money lending on any given day permissible for a scheduled commercial bank?
125% of
100% of capital.
100% of capital.
125% of
any given day, 125%.
Okay. Good.
Average.
Please mute yourself. Please mute yourself. Thanks. The answer is as per the bank's approved board policy. Lending. Borrowing, RBI has kept up to 100% of your capital funds as a daily average over a fortnight and up to 125% of your capital funds on any one day. Please be clear on these things. Don't confuse each thing. That is why I have put it in table also extra. Anyway, now we move on. RBI is willing to accept money, borrow money under reverse repo at 3.35% from all commercial banks or not necessarily commercial banks, even whoever is having a access to the eKuber platform by virtue of having an SGL account with Reserve Bank of India for holding government securities and a current account with Reserve Bank of India for holding the cash. So if these two accounts are there, you are eligible to participate in the LAF market, and banks can park the money with RBI at 3.35%. So what is to be understood is, you are Canara Bank having 1,000 crores extra today in liquidity. Your CRR requirement is say 40,000 crores, and you are having 41,000 crores RBI balance. And somebody comes and asks for call money borrowing. I want 500 crores. I can take 500 crores. Give me at 3%. He quotes, bid is the buyer's rate. He quotes at 3%, I can borrow. So will you lend him or not?
We will lend him, sir.
Why should you lend him at 3% when RBI is an open borrower for your money at 3.35%, and that too he is willing to give you government securities for that 1 day as collateral and credit it in your SGL account, whereas if you lend it to the other bank, Canara Bank is taking a unsecured exposure on the other bank, and that too at a lower rate than 3.35. So the point to be understood is 3.35 acts as a floor for call money. There is no compulsion to lend below that rate for anybody having access to giving money to RBI under reverse repo and taking securities from RBI, which these securities will get credited to your SGL account, and so they can form part of your SLR also, double benefit, okay, and a secured form of lending money. So 3.35 reverse repo acts as a floor. Now, the at 5.40, the repo rate on 30th of September, I think the next monetary policy committee meeting is to be announced. And at that time, we are eagerly watching to see whether RBI will raise the repo rate further. So if you keep on looking at what the US Fed has done, they have increased by 75 basis points twice, and they are looking at a terminal rate of around 4.40 there. US Treasury yields have risen from the bottom of 0.25% and all to now 3.75%, their 10-year bond yield. Similarly, here, the 10-year bond is now around 7.40, and RBI has also indicated they won't talk directly that this will be my decision. They'll keep the market guessing. So you should know how to read their lips. So here the terminal repo is being looked at something like even 6.15 and all. So another 75 basis points rise can happen. That's okay. That is on incidental only. Today, 5.40, RBI is willing to lend money to any bank who wants to borrow. But that bank should deposit or pledge government securities with RBI and then only borrow money. So only those banks who have surplus SLR can pledge the government securities with RBI and borrow money at 540. So as a borrower, if you go and ring up Canara Bank and say, give me call money, and Canara Bank says, at a 5.5%, I can give you 500 crores. Then you will say, sorry, boss, 5.5, I'm not interested. At 540, RBI is willing to give me money and I have surplus SLR with me, I can pledge. So effectively, 540 acts as a cap. So this is the two-way fungibility that is happening by RBI, liquidity being infused at 5.40% and liquidity being withdrawn from the system at 3.35%. Now, earlier, the difference between the reverse repo and repo rate was only 25 basis points. Now, you may ask why it is 3.35 and 540. For that, now this is the LAF corridor. So, call money normally oscillates between 3.35 and 5.40. That is why we call it the LAF corridor. Now, recently, means about I think 2 monetary policies back, RBI has introduced the standing deposit facility, which is any surplus money, instead of parking with RBI under reverse repo, you can put it under the standing deposit facility at 5.15%. So, please mute yourself. Please mute. Effectively, what is happening is RBI is giving a message to the market that I am keeping the reverse repo rate wherever it is, but I am giving you another opportunity to park your means the bank's surplus at a higher rate of 5.15%. Now the differential between 515 and 540 is again 25 basis points only. So that differential is also gained. Now there is an additional level of that will come. Two-way liquidity corridor. Now, how much you can borrow through this repo window from RBI? Every bank can borrow up to 1% of their net demand and time liabilities. Out of that, 0.75% of the NDTL you can borrow under 14-day term repo, and 0.25% of the NDTL you can borrow on a daily basis. Now, if you look at the RBI site and start reading the press releases, you will get better idea of what is happening. Now, there is one more level of liquidity being infused by the RBI for those banks who do not have the surplus SLR. So only if you have surplus SLR, you can go and pledge at 5.40 under repo and borrow from RBI. Now, suppose you have exhausted your surplus SLR, still you are short of money as a bank. At 5.65% marginal standing facility, you can still avail. First, again, surplus SLR without limit you can avail, because at 540 only up to 1%, here without limit. And additionally, by dipping into 2% of SLR. That means if 18% is the SLR rate, for borrowing under MSF at a higher rate of 5.65% and pledging government securities to RBI, you can effectively keep on, you need to keep only 16% of your NDTL as your SLR. You will not be ranked by RBI as a defaulter under SLR, because that 2% you have utilized not for your commercial lendings, but only to borrow from RBI under MSF. So that is the facility given. 18 minus 2 up to 16% only you need to maintain SLR. That 2% extra securities that is released is to be compulsorily pledged with RBI for borrowing under MSF at a higher rate of 6.5. Now, with effect from July 21, this 2% leeway has been raised to 3%. That means under COVID, when there was a requirement for many banks to still borrow, RBI as a temporary measure increased that leeway to 3%. But from January 1, 2022, they have again restored it to 2%. This is just for information only, because in some question somewhere you will come up and say that site I went and answered and that was wrong and all. So this is a brief interim period. This measure was there. It for clarity. Now the CBLO is now extinct, but you understand that to realize what is TREPS. Okay, collateralized borrowing and lending obligation is what CBLO. Don't by heart, because the full form asking and all is out of date now. In an objective question, nobody asks for a full form and all. Your what is that? Logic is what is being tested. Yesterday itself in one question you would have now realized how I should look at CRR maintenance and how a bank is defaulting or not. And all of those who interacted.
Excuse me, sir.
So in the previous slide, you have like calculated 18 minus 2 equals to 16. That is not clear, sir.
Assuming that the SLR prescribed by RBI is 18%, and given in the notification of RBI for marginal standing facility that you can dip into your SLR up to 2% of your NDTL, effectively on a day when you are borrowing from RBI under marginal standing facility at a higher rate of 5.65%, you will be maintaining, or you need to maintain, only 16% of your NDTL as mandatory SLR. RBI will not penalize you.
What is 18 here? Sir, sorry to repeatedly ask you.
What is 4% for CRR or 4.5%?
Yes.
It is prescribed. Similarly, 18 is presently prescribed. RBI under the Banking Regulation Act can bring down SLR to 0%, or maximum SLR they can take it to 40%. Yesterday we studied. So right now it is 18%.
Okay, we are assuming it is 18%. Okay.
I'm not assuming, it is what is RBI has declared now.
Okay.
Sir, full form of TREPS.
Wait. So this is TREPS is tripartite repo system. That's all. Actually,
18% and 4%. This comes under Banking Regulation Act.
CRR under RBI Act and SLR under Banking Regulation Act. Yesterday itself in the slide I have shown, and I marked R in red for how to remember it. CRR ends with R, so that is RBI Act. You start with R, and SLR under the Banking Regulation Act. Okay. Now you will ask me, SLR is also ending with R, and you have to have your own mechanisms for recall. Okay. Heuristics, self-learning. Okay. Okay, good. TREPS is a tripartite repo system. That's all. There is no full form given anywhere in the book, but some of the RBI circulars I have seen it as. But everywhere in CCIL side there is a lot of literature about TREPS. So this is what is TREPS. Now, what is collateralized borrowing and lending obligation? and how it has been replaced by TREPS. Now, all lenders of money under repo, not RBI, I am saying, all market participants, like say an ICICI mutual fund, a Birla Sun Life mutual fund, a Life Insurance Corporation of India, even State Bank of India, Canara Bank, everybody. The earlier institutions, they cannot lend in call money. Even Canara Bank or say State Bank of India, who can lend in call money, their board would have approved or kept certain limits, and perhaps they would have exhausted that limit of lending in call money also. So they still want to park money somewhere, short overnight. So they will give their willingness on the CCIL platform that money is available with me to lend. At some rate, they will give. It will be below 540 definitely, and it will be above 335. Now, how that will get balanced and all, you just see how a stock gets traded, an Infosys share at 1,400 or 1,500. It's all anonymous, electronic, bid and ask based order matching. Similarly, here also, NDS own negotiated dealing system order matching. So under an order matching process, all the people who want to, lend money will put their orders. But this is not clean money, unsecured money. You have to, the borrower has to pledge securities with them. So all the borrowers will offer securities from them to the CCIL pool. So CCIL is the common counterparty. There are 10 willing borrowers with government securities ready to be transferred from their SGL account, and maybe there are 15 lenders who are willing to receive these government securities and lend money for one day against that. Now the rates, somebody is quoting 535, somebody is quoting 530, lender I am saying, and somebody is quoting 525. And a borrower comes up from say 5%, 515, 520, and then they match at 525, the first deal happens. So like this, so that is where a borrower pledges government security without knowing from whom he is getting the money, because the SGL account of that borrowing bank gets debited with government securities and it gets credited to the CCIL's common account, from where it goes to the lender's account. And the lender in turn will transfer the money, which will get credited to the borrowing bank's account with RBI. So essentially, government securities form the underlying security, which is anonymous. But when it gets credited to the lender's STL account, it is eligible for being reckoned as SLR for the lender. So that much you realize. Yesterday itself, I have shown how balance sheet neutral is a borrowing or lending under repo. Whereas if you borrow in call money, it's a liability is being created. So it is not balance sheet neutral. That also yesterday I have shown. So this was what was happening earlier. Now, though CCIL was the common counterparty, under TREPS, there are certain augmented roles being handled by CCIL, and they do certain due diligence on payment and settlement mechanism too. That's all. Just understand. Don't go deep into that. So CBLO has now been replaced by TREPS, where there is a borrower, there is a lender of money, borrower with surplus government securities, and CCIL acting as the tri-party agent. So that is why it is called tripartite system. Securities received under CBLO, lending forms part of SLR, current account and SGL account holders can participate. I have already told this. So this
Sir,
is from
sir, why it is kept anonymous? Anonymous, why it is kept anonymous?
When you buy a share on NSE, are you bothered whether it is being sold by Narayana Murthy or Sudha Narayana Murthy or some other maybe Jardine Fleming mutual fund? Are you worried?
No.
No, just like that. That's all. That's all.
Sir, in nutshell, we can say that CBLO is just like a platform by which we can invest the money to other companies.
No, it's not a platform. There is no other companies, only market participants in the NDS OM e-Kuber can participate, and only government securities can form underlying security that is to be pledged. And 1 second. Only government securities can be pledged, and it is available only for members of CCIL, that NDSO mechanism. So there is, don't confuse. We are talking about only CRR compliance and ways of generating liquidity or ways of parking surplus liquidity. So don't go into stock market. But I mentioned stock market example to make you understand about anonymous trading and order matching of price discovery. That's all. Okay. So tripartite repo came in from 2018. See, collateral selection, payment and settlement services, custody and management. All these were the additional roles being taken up by CCIL as the tripartite agent on behalf of the borrower and the lender. So that is what it is. Just understand that much. You don't go deep into that. Why a tripartite arrangement? Because this is to align with global settlement standards. Okay, first thing. And we are much ahead of other countries in terms of NPCI, in terms of DVP. What is NPCI? I will be covering. DVP I will be covering. So relax. India is much ahead in terms of technology and the attendant risk mitigation measures. Now, funds are settled on net basis along with outright trades maturing for same day. What is this net basis? I will be covering shortly. Relax. Now, membership in CCIL and Clear Corp dealing system is required. That is a subsidiary of CCIL only. So you understand it for examination purpose as membership of CCIL. And there is a principle of novation. If anybody is there with a law background, he will understand it much better. Novation means stepping into the shoes of the other. And it means for the borrower, he borrows from a lender. Say maybe borrower is, I would say, Shamrao Vittal Cooperative Bank. And lender is a Canara Bank. So for Shamrao Vittal Cooperative Bank, the counterparty becomes CCIL. CCIL steps into the shoes of the Canara Bank as a lender. He becomes the tripartite agent. Similarly, for Canara Bank, the counterparty becomes not Shamrao Vittal Cooperative Bank, but CCIL, who steps into the shoes of the borrower. So the tripartite agent CCIL, by a concept of novation, is the common counterparty for borrower and lender. This a question can come, what is novation, and various choices can come. So you should be very clear whether the shoe is polished, whether he has stepped in correctly, tied laces correctly. I don't know what will be the answer choices. So all this can form part of the answer. Now, if you borrow under TREPS, the advantage is you don't increase your liability, so no CRR. And for the lender, it is eligible as SLR because his SGL account is credited with that much of government securities, which forms or which can be taken into consideration as part of his SLR. And maximum period permitted is up to me. Now, this is DVP. Under DVP, I will elaborate on debt basis. Still, then please hold back your anxiety. This is another instrument in the money market that is up to 1 year, bill rediscounting scheme, where banks rediscount bills of other banks. Now, Reliance Petroleum has shipped petroleum to so many pumps, and they have a 100 crore bill portfolio of receivables from the petrol bunks. Say Canara Bank is a banker to Reliance. Now Canara Bank wants money. So these bills all bundled together, they will put the seal from behind that it is co-accepted, and then they will borrow from, say, Bank of India. So that is why now the bills of Reliance through Canara Bank go into Bank of India's balance sheet as an asset, and Canara Bank borrows money. So banks rediscount bills of other banks, BRDS. So this is a money market instrument, no secondary market. Now Bank of India cannot again rediscount this bill with another bank. No secondary market, only once you can rediscount. And for Bank of India, who is lending money to Canara Bank under the underlying of the Reliance's bill, the exposure is not on Reliance but on Canara Bank. So only 20% risk weightage for rediscounting bank. Bank of India is the rediscounting bank. For him, it is, if it is on Reliance, it is 100%, of course, ignoring the credit rating of the company, that is AAA, AA and all, assuming, but because it is on a bank, all bank risks are risk weighted at 20% under Basel norms, provided Canara Bank's CRAR is minimum 9 plus that 2.25 under that, what is 2.5 under that, what is that, CC, capital conservation buffer. So 9 plus 2.5, 11.5. That you will understand a little later when B module is covered, it will come there. Then, so now from B less than 1 year, we move over to wholesale debt market. This is above 1 year. Wholesale debt market segment, it is called under CCAL also. Now the main thing difference is up to 1 year, there is no discounting, there is no compounding of interest for all the calculations. So simple formula, I is equal to PNR by 100. As you start compounding, when you go beyond 1 year, the game becomes more serious. It is equal to, amount is equal to P into 1 plus R by 100, the whole rise to N. That 1 plus R by 100 whole rise to N is the whole, will do all the mischief in your mathematics model, the ABM. There is a lot of discussion will happen on this annuity factor, what is that, compounding factor, discounting factor and all. At that time, more clarity will step in. So whoever has not already covered your business mathematics paper, you will get clarity, but I will definitely make you understand the principles. Don't think that I will run away. No, I will make you understand the principles. From a 40-year young MD, you just need to know what it matters to me when I say about a IRR. That I will make you understand. Okay, so wholesale debt market segment, there are government securities, treasury bills and dated securities. So treasury bills, yesterday itself we saw mainly 91 day, 182 day and 364 day contracted maturity, and as each day progresses, the residual maturity gets reduced. And beyond 1 year, any government security is also called as a dated security because it matures for payment on a fixed date. Now, they are credited or held in the Reserve Bank of India's public debt office in SGL form, subsidiary general ledger, and they are all covered under the public debt. Okay, negotiable instruments redeemed at par. So if a government of India bond is falling due on 15th August, it will be redeemed for full 100 rupees on 14th August itself. You be very clear on that, just like your treasury bill, redeemed at par. Maturing on holiday, redeemed the previous working day with full interest, 100 rupees is the redemption at par. Okay, that you be clear. And by default, the coupon means the interest is paid half yearly on Government of India bonds, and that is why they are also called as fixed income bonds. You clear CAIB with 90 marks and join, say, Birla Mutual Fund as a money market trader. On your visiting card, you will be putting dealer fixed income, dealer derivatives, like that. So fixed income means you are dealing in mostly government debt. There is a communication you are giving. And the self-regulatory body, just like your FEDI for Forex, in rupee, it is FIMDA. We'll be covering that. You need not note down. FIMDA means FIMMDA, Fixed Income Money Market Derivatives Association. So there also the fixed income gains relevance. Why it is called fixed income? Because the interest remains constant. If, in the next slide, we are covering how exactly a bond is called and how the interest remains constant. But because the interest remains constant and every 6 months the interest is paid, so the frequency of payment of interest for a Government of India bond is 2 in a year, twice in a year. Unless otherwise, it is given as 1 annual payment or 4 quarterly payment in the question. If nothing is given, it is 2. And this frequency of payment has got an implication in our calculations. So remember that. Now, how a Government of India bond is called and what are all the characteristics of that bond. Now, this is one bond which was issued in 2020 as a 10-year bond. So what is the residual maturity of the bond as of 1st December 2022?
8 years.
Good. That's all. 8 years. So today it's an 8-year bond, but It was a 10-year bond issued on 1st December 2020. And 585 GOI 2030, 112 2030. This is how you will see the nomenclature of the bond in the CCIL NDS home platform. If you log in, you need not be a treasury man of the bank and all. You don't have any login password, nothing. It's all public domain. Anybody can go and see what is the price of this. But there, that 112 2030 may not be given, only 585 GOI 2030 will be given. If you go into that ISIN number, you can find out what is the maturity date also. Now, what is this 5.85% known in the market? This is what is called the interest rate of the bond, which is fixed throughout the 10 years, right from 1st December 2020. And that is also called the coupon of the bond. Coupon bearing bonds, fixed coupon bonds, fixed income bonds, various names will be given in various books. So this is the coupon of the bond. Issuer is Government of India. Yesterday we discussed about issuer credit risk under a repo. Your account is credited with Government of India bond. But if Government of India were to declare that I am bankrupt and I will not honor your bond for another 10 years, you means as investor in that bond, you run a credit risk against Government of India. That is what is termed as issuer credit risk. So that is why, who is the issuer? It is Government of India. If it is 585 TNSDL 2030, the issuer is Tamil Nadu State Development Loan, so it's Government of Tamil Nadu. If it is 585 JKSDL 2030, the issuer is Jammu and Kashmir. If it is 585 MAHSDL 2030, the issuer is Maharashtra State Government. So that is the concept of issuer. This is the tenor of the bond, 2030. So 2030 bond means today it's an 8-year bond with residual maturity of 8 years. And this is the maturity date. So this is how generally any bond is called or defined on the trading platforms. So 585 Government of India 2030 is traded at 98.80, corresponding to a YTM of 6.01%. What is its current yield? Now, what is YTM? What is current yield? Nothing I have discussed, but I have placed the question in front of you. This is just to sensitize you. I am going to spend considerable time on making you understand what is YTM. So hold back your anxiety. The point you want to understand now is these two are different monsters that we are discussing, YTM and current yield. Okay, and current yield is of little significance to any informed banker. So you should not be moved or swayed by current yield in taking your investment decisions. But as a academic input, we need to understand what is a current yield. That's what. So current yield is, you have to pay today 98 rupees 80 paise to buy the bond if you want. Now, why it is 98.80? Who is selling at a loss? Don't ask those questions. All that you will understand once you get into the exciting field of treasury after 90 marks in the examination. Now, 98.80 you buy the bond, but Government of India says through RBI, every 6 months I will credit your account with half of 5.85. on 100 rupees. That is fixed, calculated. So 585 means some 2.925. That kind of interest every 6 months it will come to your account. So what you are getting is 5 rupee 85 paise on 100 rupees as interest, whereas you shell out only 98 rupee 80 paise. So the current yield is coupon divided by market price. It is higher than 585 because the bond is at a discount. Bond is at a discount to 100, you shell out only 98 rupees 80 paise. So effectively, the interest you get works out to something higher than the coupon. So this kind of seesaw, that kind of choices you should be able to make up in your mind about what is current yield. Will it be higher than the coupon or lower than the coupon? That kind of choices can also come in the examination. So for a discount bond, the current yield will be higher than the coupon. For a premium bond, that is 101, 102, if it is trading, its current yield will be lower than the coupon. So that is what you should understand from an examination perspective. Now, face value is the 100 rupees. book value is 98 rupees. That is assuming you have purchased it at 98 and today the market value is 98. If you have the bond in your already in your books, may not be you, your previous fund manager, your AGM funds would have bought this security in 2020 or in 2021 at 98 rupees. And today it is giving or selling or going in the market at 98.80. There is an appreciation of 80 paise from your book value. What is face value? What is book value? What is the current yield? All we have understood, and based on this, simple questions can come. No need for any calculators. You will be able to straight away answer. Now, bond, what is it? Characteristics, no? Something I have written there. Not coming on features. Okay. Fixed income securities, I have already explained that. Original tenor, RBI has got the Under Public Debt Act. I already told 1 to 40 years. In your books, it will be given as 30 years. Now the Public Debt Act has been amended to issue securities up to 40 years. Now, who will buy a 40-year bond? Mostly the insurance companies, they collect the premium from you for a term life or long life annuity plan. When you are in the age of say 20 or 25, बहुत उम्र नीचे है तो और कम है तो बहुत ज्यादा फायदा मिलेगा. All the agent will come and market to you. You also will be doing under cross-selling. You should go in for insurance policies at a very young age. And so another 40 years only the annuities will start. So the insurance companies always have an appetite for long maturity bonds. So that is, and government also, some part of the borrowing, they will borrow through long maturity bonds. That is why the tenor goes up to 40. Provident funds, yeah, they have investment appetite for long term. Then we also have one feature called zero coupon bonds. Okay, that means there is no interest payable on the bond, like your deep discount bond or your what is it, reinvestment deposit or special term deposit. So many names you will call in each bank. You don't pay periodical interest, but it matures into a certain amount. Okay, sometimes for a what is that, full rounded amount also. You pay deposit 8,500 rupees. Sir, after 3 years, we will give you 10,000. So that is the coup there. You are not paying any half yearly or quarterly interest to the depositor. Every interest gets reinvested, and then finally you give a maturity value of 10,000 to the depositor. So similarly, here Government of India can also borrow under zero coupon bonds. So no interim coupon, bullet redemption, and generally the redemption is at par. Technically, you can have a premium redemption bond also, technically, academically, but generally at par. And you also have floating rate bonds. What is the meaning of a floating rate bond? There will be two characteristics to a floating rate bond. One is the anchor rate on which the coupon will float, and the second is the frequency at which the floating rate will be reset. I'll explain it, please, don't worry. Now, this is one example of a floating rate bond. It will be called plus 1.25% floating rate bond 2030. And that plus 1.25 means it is the anchor rate is the 364-day Treasury bill yield, over which this floating rate bonds coupon will be fixed at 1.25% extra. So if the Treasury bill yield for 364-day tenor is say 5%, this bonds coupon for the next 1 year will be 5 plus 1.25, 6.25. And every year the interest rate will be reset. That is why it will float. It will float over the 364-day Treasury bill yield, and it will float every 12 months. So next, after 12 months, if the 364-day Treasury bill yield has gone up 7%, this bonds next 1 year coupon will be 7 plus 1.25, 8.2. Then for the next 12 months, it is fixed at 8.25. Again, it will be revisited for another 12 months after 1 year. So frequency of reset annual, generally annual. And what is the anchor rate? It can be the 364-day Treasury bill yield rate. It can be SBI's 1 year FD rate. It can be a Reliance Petroleum's 1 year CP rate. But generally, all we use publicly traded benchmarks. SBI's 1 year FD rate is not a public rate. It's a proprietary rate of SBI. So there is a risk about that pricing. So generally, what this financial benchmark India Limited SBIL declared or announced publicly traded rates like MIBOR. Over MIBOR, it can be floating. So like that, publicly traded benchmark rates are chosen. And in practice, what we see is the 364-day Treasury bill yield. And if T-bill yield is 4%, FRB interest will be 4 plus 1.25, 5.25. Then we also have inflation indexed bonds, both for capital and interest. Whereas we also have capital indexed bonds where only capital is indexed. One academic question can come as a choice. So be very clear about this. Inflation index bonds and capital index bonds. When the capital gains tax calculation comes, yeah, Ramesh K, somebody raised hand, please ask. Please ask if you have a question, or if it was wrongly raised, you can lower the hand also.
So the class is going very fast.
See, where you have doubt, you will ask me. Please.
So can you explain the difference between primary market and secondary market, sir?
Yeah, it is coming. It is coming. Primary and secondary is coming. 1 second. 1 second. Yeah.
So what is this one anchor rate on which coupon floats frequency?
That's what I'm coming there. I'm discussing that.
Okay.
Okay. Anchor rate is the base rate, floating rate bond. You should float on something, no? If you are floating in swimming pool and you have a rubber mat, that rubber mat is your anchor, so that you don't fall below the water level. Similarly, here the 364-day Treasury bill rate is the anchor on which the bonds coupon will float. So when 364-day Treasury bill is 4%, the bonds coupon will be 5.25. When Treasury bill yield is 7%, the bonds coupon will be 7 plus 1.25, 8.25. Now that anchor, are you clear? Yes or no?
Yes, sir.
Well, no, you can say no also. It will be accepted. Relax. It will be accepted. I am prepared to go once again. But then what happens? Now the anchor, you are clear. So yeah, every day will this anchor be floating? No, it will float only for 12 months. Now for next 12 months, it is fixed. Then on that day, again, you let that float. And then you find out whether from 4 it has come up all the way to 7. That is where that float adjustment is happening every year, every 1 year. This has got an implication when we look at duration. At that time, you should remember. That is why I am spending time. Okay, I have not brought in duration now.
So this bond market doesn't come under money market, no? This is different, no?
Money market up to 1 year. Now we are looking at original tenor 1 year to 40 years. So this is bond market.
Bond market. Okay, this is bond market.
Good. So in bond market, we also have inflation index bonds and capital index bonds. Inflation index bonds can be indexed for capital and interest. Capital index bonds means only capital index. Capital is indexed. And we also have.
So what is indexed?
Indexation, you will learn much more in your ABM regarding your capital gains taxation and all. So at that time, it will be very clear. That is why I am not unnecessarily going into overlapping. You buy a house for say 10 lakhs and after say 20 years, you sell it for 1 crore. Now you get an indexation benefit for capital gains, and that index is declared by the income tax department that 20 years back, 10 lakhs is today's equivalent of say 40 lakhs. It is through an index. And then so your gain is not 1 crore minus 10 lakhs, 90 lakhs, but 1 crore minus 40 lakhs. So you get the benefit of an index that your investment is also appreciating the original investment from 10 to 30 lakhs. That is a concept. You will understand that when that ABM classes are finished. Otherwise, you always bounce me on WhatsApp. I will clear you. And 62 days are there. 61st day you come and ask me, I will clear it out. Don't worry.
Sir, it's written T-bill is 4%, FRB will be 5.25. How come?
How come? Because it is called as plus 1.25% FRB. If I had called it as plus 1.50% FRB, it will be 4 plus 1.50, 5.50. That is what is determined by the market participants on the day of auction. I am coming to auction, then you will get more clarity. Now I am just giving you, there is one baby called, Adra, another baby called Rudra, another baby called Chadra. Now, what is the difference between Ardra, Rudra, and Sadra? We will come as we understand the characteristics of each baby and the auction process. Okay.
So in zero coupon bonds, it shows that it's not gaining any interest. No, so why people will be interested in investing in zero coupon bonds? Since the original tenor is from 1 year to 40 years, na?
Okay. I have a daughter whom I plan to give away in marriage at the end of 20 years. And today I have got a windfall gain from my company, some bonus. They have given me, say, 20 lakhs. So if I put it in an FD, I may not renew it. I may use it for something else. I may buy a car or something else. I don't want to touch it for 20 years. So you straight away put it for getting reinvested for 20 years and give me all the money, including interest at the end of 20 years. So I put it in a zero coupon bond. Agreed or not? Now,
So I'm
Not
not reading the
clear, sir,
point.
not clear.
On maturity,
Interest will
Not-
pay directly on maturity, and no interim interest is paid. So that's why it's a
yes.
zero
So
coupon.
yes. Now, if I put it in a FD for 1 year or 3 years and renew it every 3 years for 20 years, so 7 renewals I will have to do. Okay, or 6 renewals to be precise. 6 into 3, 18 plus the original today. So 6 renewals. Now, what is the guarantee that I will have the mental framework to renew it compulsorily? I may foreclose it at some point of time. So here, I am mentally locking myself for 20 years. And there are so many other interest rate risks also I am insulating myself from, which I will be clear as we progress in the session. So I am not going into that. Now I'll cover one more thing. Now, why should an investor, why should an issuer issue a zero coupon bond? Why not pay every half year interest? Suppose it is your NHAI, they are developing Agra, Delhi toll road. So the cash flows are going to come only after, say, another 12 years. It's a big project, Agra Delhi toll. So 12 years developed, then only you will be open for traffic and cash will start coming. So from where will that toll that infrastructure special purpose vehicle, where will they make half yearly interest payment? They don't have cash flows. So they say you invest for 20 years. After 12 years, I am going to get cash flows. I will put that in a redemption reserve fund. And at the end of 20 years, I will give you full interest plus capital. So that is why it matches the cash flow profile from the issuer angle as well as the cash flow requirement from the investor angle. This is where the zero coupon bonds. Please, somebody needs to mute himself or herself. Please check whether your mute icon is on. That red color is there. Please. Yeah. So that is all about how the requirements match regarding the flow of cash flows. Okay. So please, at this point of time, बोलो.
सर जीरो कूपन बॉन्ड जो है वो हमें डिस्काउंट पे मिलेगा?
डिस्काउंट पे ही मिलेगा. Discount पे ही मिलेगा. 68 rupees. Then after 1 year, it will become 70 rupees. After 2 years, it will become 75 because that accrued interest is what is getting reflected in the price. And that is all in the secondary market. Somebody asked about secondary market. I'm going to come to that. So 75 हो जाएगा. Then और एक साल हो गया तो 80 होगा और 85 होगा 90 होगा like that. 99 then it will become 100. Okay. Good.
सर ट्रेजरी तो शॉर्ट टर्म, सर ट्रेजरी तो शॉर्ट टर्म प्लस ट्रेजरी जो है सर वो तो शॉर्ट टर्म प्लस फंड के लिए होता है ना? तो ये हम लोग सर मनी मार्केट लॉन्ग टर्म के लिए ऊपर
That you score 90 marks and get posted, then you will know what is short term and what is long term, what is intraday trading and what is view based trading, what is HFT, what is HTM, and what is AFS. All that will be available to you. Good thinking anyway. I appreciate that. You are already in the right mode. Now, okay, please let us move on. Otherwise, if you have doubts, you please bounce me on WhatsApp. Yesterday itself, you would have seen whoever has attempted the question has got the clarity also, at least by today morning. After 7 o'clock today, I couldn't look at the WhatsApp, but I have ensured that I have replied to everyone in private and on a one-to-one basis. And at least many of you have, whoever have benefited, have now realized where you have gone wrong. So I don't give the answer straight away. Okay, I make you work hard, heuristic, self-learning. Then only your clarity will sink in. So whoever wants to benefit to such questions, you please use the WhatsApp. I am available. Maybe on and off, you will have to wait, but within 24 hours, I'll be able to get back to you. So there you can clarify also. If somebody is not clear, please, I am available. Then oil bonds are issued by the government of India, or actually oil companies and government. Yeah, somebody had a doubt. Let me complete this, then I will wait for your doubt. The oil companies were to be given the subsidy element in cash by the government of India. Government of India did not have the cash, so they issued oil bonds. Okay, so that is the background. Just to cover the discussion, I am just mentioning it. You should not say, oh, iska baare mein kuch bhi nahi pata tha. So that is not the point. This is the background, but they are also characteristics of fixed income bonds only. Okay. Now somebody had a question, please ask.
So what is oil bonds?
That is what it is, issued by the government of India for money owing to the Indian Oil Corporation or HPCL or people like that, that four major oil marketing companies. Earlier, not now. Now they are all sitting on huge piles of cash. That is why the windfall tax is being discussed. Earlier, when there was a deficit, the compensation was through your oil bonds. Like your banks, your public sector banks, whoever is short of capital, your recapitalization bonds have been issued. If somebody has already started reading the annual report, it will be figuring the recapitalization bonds by government of India. Government will not give you cash as equity. They will only give you bond. So it's a double entry accounting. Your RBI account, they will first credit with money and then debit and give you SGLs as recapitalization bonds. Okay, that in module D, you will understand.
Sir, whenever you mention that bonds or treasury bills issued by governments, then it issued by finance ministry or any another ministry.
That is immaterial. The risk is on government of India. That's all. Public Debt Act. The note, you will know that it is signed by the RBI governor, except the 1 rupee note. But here it is Government of India Public Debt Act. That's it. It's not significant from an examination angle, and I do not have a straight answer also, to be precise. Let me be very open. Sovereign risk, this is what we should understand. Government of India. So whether you are open to, हाँ बोलो.
मेरे को ये तो समझ में नहीं आया. अभी we are telling that in SLR banks can have government securities and cashes as SLR. So these SLR bonds, whatever government securities are there, that is in the form of bonds, they are trading in CASL. That is what you are telling us, sir.
SLR is held in the form of 4 items. Yesterday we discussed. One is government of India bonds. It can be a treasury bill, it can be a bond, whatever. So all that we are talking now is forming part of your red rectangle that on yesterday morning I showed the balance sheet formation. Investments, I showed a red rectangle on the asset side. That is what is your SLR. And the what is going into that red rectangle is all these government bonds and T-bills. Okay. You can also hold as a SLR, meet SLR in the form of your excess CRR. Then your branch cash balances. Then your primary gold. These are the 4 permitted categories of investments for meeting SLR.
Okay. Yes.
CRR only RBI balances.
Yes.
Not even branch cash. That is a question. A question will come. Please be clear. Hmm.
These bonds banks are getting from public, or we
Now,
are
Government
taking
of
from
India. Government of India. Government of India. But from where you are getting, if you are buying in the secondary market, now after 2 years, you are buying 585 GOI 2030 at 98.80. Seller may be State Bank of India, you may be a Union Bank of India, buying it from SBI. But 100 rupee I am giving from my pocket to you. But same Chakrikanta Das signature only is there, no? That is the point. Fungible. It is getting the same 100 rupee value, whether it is in your pocket or my pocket. So 2 years it was in my pocket. I have received half yearly 585 by 2. Now you are going to get 585 for another 8 years. That's all. Clear?
Okay, sir.
Intermittent cash flows. This is what is the real mischief that is going to happen in the mathematics, bond mathematics. Fabusi. Fabusi is the Bible on bond mathematics. FABOZZI. Okay, big book. And whoever scores 90 marks can get that book bought by your bank under bank's expenses. In the bank library, you buy it and read it. Okay. Now, intermittent cash flows, the coupon, so that will what will determine the value of a bond and how the price changes. I'm just sensitizing you now, but I will take you through the process. So you wait for the entire curtain to unfold. Till then, you be attentive. And this we have repeatedly now said, redeemed at par. So the final payment by Government of India through RBI is 100 rupees. Okay. And the coupons, that is half yearly, that 585 by 2, are reinvested for compounding effect. That is the assumption. Now, whether you are going to reinvest that or whether with 5 rupee 85 paisa you are going to put the pan top, that is your decision. But understand the price and see how best it is being utilized, whether it is Union Bank of India, whether it is SBI, whether it is LIC. The market assumes that whoever receives the coupon will reinvest it so that he gets the compounding effect. That is the assumption for all mathematical calculations. You cannot say that there is a, what is that, for the blade, all these NBFCs, when they give loan, they will say 0 interest. But if you calculate the IRR for the cash flow, it will be minimum 24%. Because one EMI you pay in advance, you pay a processing fee 1,000 rupees. All these tamasha, and the amount that is given to you will be net of that one EMI. So then they will tell you are going to repay 10,000 rupees loan, whereas you will be repaying an 8,500 rupee loan. So all these gimmicks is about the compounding effect. And that is what we are going to neutralize by understanding what is IRR or what is YTM. Both are same. You will understand that. Now, somebody asked about secondary market and primary market. Every Friday, Reserve Bank of India, in their role as the merchant banker to the Government of India, when Nirmala Sitharaman on February 1st got the budget announced and then later on passed by the Parliament, she has got the authority under the Public Debt Act and the FRBM Act, Fiscal Responsibility and Budget Management Act, to raise from the public through Government of India bonds of various maturities up to say 4 lakh crores. It is there. Kidhar se mila? If you have been listening to the RBI site or the budget speeches or the papers that came Economic Times or Business Line on 2nd February, it will be there. So this is the characteristic of primary market. Now the entire 4 lakh crores Sitharaman does not need on March 1st or April 1st. So every week RBI has given an auction calendar. For 6 months, they will give an auction calendar up to September. And now from October to March, they will give a second auction calendar. As per the auction calendar, every week, Friday, an auction happens for various maturities. Generally, now 4 different maturities auctions are happening for about 22, 25,000 crores. So if you start looking at the RBI press release, you will know how this auction is happening. So that is the primary market. Okay. Now, after the auction, after 2 years, you go to the NDSO and put a bid at 98.80 for 585 GOA 2030, and somebody, yes, Mahesh.
What is intermittent cash flows?
Intermittent cash flow, I am coming shortly, please. So 585 2030, you put a bid on NDS home and then somebody sells it to you, order matching. You need not know who sold it to you, but your SGL is credited tomorrow, T+1. By default, the settlement procedure for Government of India bonds is T+1. Tomorrow, your SGL account is credited with that 585 GOA 2030, which was issued 2 years back. So this is the secondary market. Now, for 2 years already have passed. For that, 4 half-yearly coupons have been credited to that. Suppose SBI has sold it, SBI's account already. That is the intermittent cash flow for the seller who held on to the bond for 2 years. Next 8 years, you are going to get the intermittent cash flow of half-yearly coupons. So the terminal cash flow is 100 rupees principal and intermittent cash flow is the half of the annual coupon that is being declared. For a 6% coupon bond, every 6 months, 3 rupees will be the intermittent cash flow. And terminal cash flow will be 100 rupees. Have I answered you, Mahesh? Okay. So this is about liquidity. You need not outright sell it. If you sell it in the outright, you get a secondary market exit. You can pledge it under repo or under MSF with RBI. Okay, that is about it.
So can you explain the secondary market once again?
Secondary market, I am going to explain now. It is going to come in detail now. Please wait. Now, why should the bond which was originally assume it was issued at 100, it need not be, but assume it was issued at 100. Generally, of course, on the first day, it is always issued at 100, correct? And the coupon is fixed 100. So why should it go down to 98.80? Similarly, why should it go up to 102 in between? That price movement is what we are trying to understand. Okay, so be attentive now, then you will know why the secondary market is happening or why it is existing and why it has got a different price than 100. That is what you should understand. Now, assuming a cow you have which is giving an yield of 10 liters. Okay, 10 liters. And you paid how much for that cow? 50,000. Okay. And the milk yield of alternate cow, that is now after 2 years, another cow has come which is yielding 16 liters. So your cow will have what value now if you go and want to sell it in this shandy, weekly shandy, you want to sell your cow. Will it be above 50,000 or less than 50,000?
Less than 50,000, sir.
Less than 50,000.
That's all. That's all. I don't want the number 38,000. That I have put just for you to make.
Please repeat.
I'll repeat. Somebody needs to mute himself, please. Please mute. Yeah. You bought a cow for 50,000 rupees and the yield at that point of time was 10 liters. And in the market, any cow was on an average giving 10. Now the yield of milk, assume it is throughout 10 liters for your cow. It is not going to change. It is like the coupon on the bond. It is not going to change. Similarly, this milk yield for your cow is going to be 10 liters throughout. Now, a new breed has come which is giving 16 liters yield per day in the market. So, if you take your cow in the market, it will fetch a value less than 50,000 only. Are you clear about the direction? That's all I want.
Yes, sir, clear.
Clear. So, when interest rate goes up from 10 to 16, your bond price will fall from 50,000 to 38,000. That is what I'm trying to communicate. So after this slide, cows will disappear, only principal and coupon will be there. Okay, so at that time you should be clear. When interest rate goes up from 10 to 16, which is equivalent of milk yield, the price of the bond will come down from 50,000 to 38,000. एक बार और बताइए, हाँ, clear या नहीं?
Yes, sir.
Yes, sir.
Thank you. Thank you. Now there is a drought in the market or in the, what is that, economy. and all the cows, the yield is coming down. Your cow is still giving 10 liters, no change. In the market, if you go and buy a cow, you will get only a 6 liter per day yield cow today. Another situation. So your cow's value will go up from 50,000 or less than 50,000.
Up, sir.
Increase.
Up.
Automatically.
Up.
Down.
This if you keep in your mind, you will get 100 marks. You will not lose a single mark. Okay. So when interest rate goes down from 10 to 6, the price of the cow or bond will go up from 50,000 to 60. This is the seesaw. One, interest rate is going up 10 to 16, price is coming down 50,000 to 38,000. Interest rate is coming down from 10 to 6, price of the cow is going up from 50,000 to 60,000. So just the opposite direction in which the price and the interest rate move. Interest rate means the present interest rate, which is with reference to the coupon. That's all. We will clarify that. Keep it in mind. I know it is not fully clear. So this is the coupon of the bond and price of the bond with a coupon of 10%. Okay. So when coupon is 10%, the price is 100. When coupon goes up to 16, price come down. Now, why it is coming down to 89? Why not 88? Why not 98? Why not 78? We will bring formulas shortly. Now only understand the direction. When interest rate goes up from 10 to 16, the price direction is opposite to go down. Interest rate goes up, price comes down 100 to 89. And interest rate comes down from 10 to 6, price goes up from 100 to 124. Are you clear now about the directional movement of price and rate?
Yes, sir.
Yes.
Yes, sir.
So keep this in clear mind. In the computer, you will not see me behind or an Amitabh Bachchan behind as a friend in need and all. So only you and your logic reasoning such questions. Oh, cow किधर था, red में था या green में था? You keep that in mind. And if you keep that in mind, your logic will help you. You need not by heart anything. Logic alone is sufficient. Okay. So interest rate and price of bond move in opposite direction. This much if you are clear. Now we will try and find out at what point of that opposite direction they will neutralize. And that is the science of bond mathematics, bond management, treasury portfolio management, profit making, everything is built upon that. I'm going to take you to an exciting field now. After this, we are at 10:42. No problem. We can still have another 20 minutes. Yes. Yeah. So all this price movement with reference to the interest rate movement is captured in one word as market risk. Any price movement is market risk. If it's USD INR 80 to 81, that is a market risk. And specifically under market risk, it is called an exchange risk. Now bond going up from 100 to 102, it is called an interest rate risk. That's all. One is an exchange risk, another is an interest rate risk. That's all, but all are covered under market risk. That's why Asset Liability Management Committee is called otherwise the Market Risk Management Committee, MRC, but popularly known as ALCO. Okay, so this is the interest rate risk, and it is manifested in front of you. Nobody will tell you interest rate risk. Price both fluctuate over a. That is the what is you are perceiving in our dealing room. Price risk. So how it manifests to you, bond niche ja raha hai. That is what is your manifestation of the interest risk in terms of price risk. And as the price risk surfaces, this reinvestment risk also comes in. You will spend considerable time on reinvestment risk. So just understand there is a complementary or what is running along with price risk as reinvestment risk. I will explain it. I got a animated chart, a slide itself. Now, interest goes up, price comes down. We have already seen that. However, when interest goes up, reinvestment of coupon happens at higher rates. Okay. Now, what is this reinvestment? Assuming it is a 6% bond. So after 6 months, you will get 3 rupees. Correct? Half yearly coupon, 3 rupees. Agreed or not?
Sir.
So this 3 rupees, the market assumes that you are going to reinvest at, say, that YTM rate 6.01. I showed in the earlier equation example some 4 or 5 slides back, 585 GOI 2030 at 98.80, equivalent to a YTM of 6.01. I showed. That is just for understanding only. So that what I want you to understand now is that when I said at a YTM of 6.01, its price was 98.80, the market or anybody, the buyer, the seller, the mid office, the third person, the Economic Times analyst, everybody who looked at the price found out or assumed that a 3 rupees half yearly coupon is getting reinvested at 6.01% itself, the YTM rate itself. We will come to YTM, what it is, and how the reinvestment happens separately. Still, slide is there. But I'm just preparing you to mentally understand that there is a reinvestment requirement or assumption happening in the market when a fixed income bond is being discussed. It is not only the 100 rupees or 98 rupee 80 paise minus 100, that 1 rupee 20 paise gain that is being discussed. It is the 3 rupees that is coming every 6 months, which is assumed to be reinvested, is also being discussed. That is the reinvestment part. Now, that 3 rupees which you have assumed to get reinvested at 6.01%, which is the YTM, if interest rate goes up from 6.01 to 7.01, price ऊपर जाएगा या नीचे जाएगा?
नीचे आएगा डाउन.
Very good, very good. So 98.80 से वो नीचे आएगा. Say number, whatever number, 96 for assumption. But that is not important now. It will come down. That is important. So when what you bought at 98.80 is going to come down to 96, you are smiling or weeping?
Weeping.
Weeping, sir. Weeping, good. लेकिन आपको इतना दुख या नाराज नहीं होने का नीड है, क्योंकि a market में nature is giving you a protection that the 3 rupees you got, if you assume that you will reinvest for the next 8 years at 6.01%, as nature, I am giving you, the market is giving you an opportunity to reinvest at 7.01%. Are you slightly happy now?
Yes, sir.
So you assume that every 6 months I will reinvest 3 rupees at 6.01, but market is giving me a compensating opportunity to reinvest at a higher rate of 7.01%. क्योंकि market में interest rate बढ़ गया. And because of that interest rate rise, I am suffering from 98.80 to a fall to 96. But I am partly compensated. Yes or no?
Yes, sir.
That's all.
3 rupees would reduce, no, sir?
Which will reduce?
The interest what I earn, 3 rupees, that also would be reduced.
How it will reduce? That's why I said fixed income bond. Whether market interest is 7% or the market interest is 4%, market interest is 12%, for the next residual tenor of 8 years, this 6% GOI 2030 is going to give you 3 rupees, 3 rupees, 3 rupees. No change. That bond, there is no change. But what you are going to make for the next 7.5 years, next 7 years, next 6.5 years from this 3 rupees that you had assumed you will reinvest at 6% or 601. Now you are getting a benefit to reinvest it at 701. And if interest rate keeps going up, you will get a benefit to reinvest at 801, 901, like that. Okay.
क्या कर रहा है बेटा? गंदा हो रहा है ना, जो नीचे जाएगा. यहाँ मत गंदा करो, पेट गंदा जाएगा, चींटी लग जाएगा.
Please mute yourself. नीचे हो रहा है, जान हो रहा है, something. Please. Yeah. So
finally, there will be a loss, sir. As per this also.
Relax. Don't start computing the P&L now. You score 90 marks, you will compute the P&L every second, every day, evening, everything. You will get an opportunity. Don't start computing the P&L. Finally, loss. I will come to that. I will not leave the discussion here. I will come to that. But You go step by step about the movements and what kind of natural support mechanism you get in the half yearly intermittent cash flows and the terminal cash flow of 100 rupees that get balanced somewhere. That's all you understand now. Okay. This much clear or not?
Sir?
Ah,
No, sir.
so what I have written is when interest rate goes up, the reinvestment of coupon happens at higher rates. 601 में हो जाएगा was your assumption. अभी 701 and 801 में हो रहा है. So reinvestment risk is in your favor.
Sir, please speak in English, sir.
Haji, I'll speak in English. Yes, absolutely. So reinvestment is happening in a higher rate of 601 to compared to 601, 701 and 801. Whereas the price risk is against you. Okay, because from 98.80 it has fallen down to 96 or whatever it is. So price risk is against you, reinvestment risk is in your favor. Just the other way, if interest rate were to fall, your 98.80 will go up to 99.80. Price risk is in your favor. But what you have assumed you will reinvest at 601%, you will be able to get a chance to reinvest at only a lower rate of 501. So reinvestment risk is against you, price risk is in your favor. Now this we will again examine from this formula. Price is equal to cash. This is just the IRR formula only. All the cash flows when uniformly discounted.
Excuse me, sir.
Please.
Sir, we can, sir, हम किसी भी bond को reinvest कर सकते हैं?
Bond को नहीं, bond का intermittent cash flow को reinvest कर सकते हैं. Not only कर सकते हैं, you have to reinvest. If you don't reinvest, that is your choice. But the market which is giving the price will assume that you are reinvesting. Okay. Now it will be very clear when we look at this equation. Okay. Now, if you ask me what is the formula for YTM, you will ask on the 61st day, you will call me and ask me, okay, YTM ka formula. There is no formula YTM equal to. First time, yield to maturity is YTM, same as IRR. In Excel, if you put XIRR, you will get the YTM itself. Pankaj Tripathi, please keep my screen free. Thank you. So, PV, price, present value is what is PV. This you will study at length in your ABM paper also, business mathematics. So, but what you need to understand specifically from a bond context, right, the relationship between price risk and reinvestment risk, that is what we are trying to find out here. Cash flow 1, assuming it is 6% bond GOI 2030, this 6% means half yearly cash flow is 3 rupees. Cash flow 1 is 3 rupees. And present value, the earlier equation we told on 98.80. So 98.80 price is equal to cash flow 1 by 1 plus R, cash flow 2 by 1 plus R square, cash flow 3 by 1 plus R cube, and last cash flow is principal 100 rupees plus that last 6 months interest 3 rupees. So 103 divided by 1 plus R, the whole rise to N. Okay, this is the formula. Now, the definition of what is IRR or what is YTM is the uniform discount rate. Look at the red R, all same R. The uniform discount rate, uniform. I'll be repeating it any number of times. IRR is the uniform discount rate R, at which when all the future cash flows are discounted, C1, C2, C3, Cn, all the future cash flows are discounted, equates with the current price. Current price is 98.80. At whether your mid office works out, whether economic times analyst works out, whether CNBC Lata Venkatesh works out, everywhere it is the same 98.80, because everybody has assumed that each 3 rupee you get is getting reinvested and discounted at 6.01%. That is why this uniform discount rate R is 6.01. And if this is 6.01, then you will say this bond at 98.80 is equivalent to a YTM of 6.01%. That is all. If it becomes 98, price has come down. So YTM in other terms means interest rate. It will go up from 601 to 605, 606 like that. So that is why the price and interest rate, or interest rate means YTM in loose parlance, it will go up. So YTM, it goes up means price comes down. Price goes up means YTM comes down. So it's a dynamic process. It is not that now for next years, 8 years, it will be 601 itself. No, every day it will keep changing. Okay, now we will analyze it more. YTM is that uniform discount rate R. That is why I put the same red R everywhere, at which when the future cash flows are discounted, future cash flows are C1, C2, C3, Cn, gives the price of the bond. Price is today's price. So this is a back solving equation. Price is known. And then at this price, what is the YTM is what you are calculating or picking up. So it is not R is equal to, that is not the formula, but price is equal to C1 by 1 plus R, C2 by 1 plus R squared. And what is that R is what you are finding out by trial and error. Now, this presupposes that all future cash flows are reinvested at the YTM rate R. So if you work out this as 601, then the presupposition is that this is uniformly reinvested at 601%. Now the limitation. So when reinvestment happens at 701, 801, 901, the price would have come down from 98, 82, 96, 94, 93, like that. And when interest rate comes down, the reinvestment would be happening at 601, 501, 401. Price would have gone up from 98, 80 to 99, 100, 101, 102. Opposite movement. So price risk and reinvestment risk always move one against the other. Okay. Now this is called yield to maturity, that R. It's a promised yield, not a realized yield, because it assumes that every 6 months you are going to reinvest at 601. It's a, whatever it, the YTM rate itself, but it's not a realized yield. It's the same as IRR for a project. That is especially for those handling retail loans, your vehicle loan and all, you will be more familiar with IRR. Same thing. Now, what are the two assumptions? All intermittent cash flows are reinvested at YTM rate. That is, intermittent cash flows are the coupons. They are all reinvested at YTM rate. And interest rate remains constant during the tenor of the bond. It is only assumed. That is why when interest rate goes up from 601 to 701, the price starts coming down. So that is where otherwise price would be throughout 98, 81. Why it is changing? Because interest rate is changed. So the assumption gets disrupted. Now, when YTM and coupon are equal, bond will be traded at par. Cow is giving 10 liters, market new cow is also 10 liters, your price does not affect 50,000. Okay, so 100 rupee bond, coupon is 6%, YTM will also be same 6%. Then when YTM is higher, now from 10 liters to 16 liters it has gone, so price will come down to 50,000 say, niche aayega. Similarly, when YTM is higher, coupon is 6%, YTM is 7%, the price will be 98 or 96 or 97, discount. So YTM is higher than the coupon, bond will be at discount. And YTM is lower than the coupon, bond will be at a premium. So these two things, if you can relate with reference to the cow and liters of milk, life will be very, very simple. Okay. Now, this is the example you just see. 563 is the coupon of the bond. 2026 it matures. Price is 100. So YTM is also 563. Our bond, coupon and YTM are same. Somebody needs to mute himself, please. Yeah. Now, 585 GOI 2030, 9880, 601 YTM. Now, YTM is higher than the coupon and bond is at discount. So when interest rate has moved up from 585, which was there for 10-year tenor in 2020, today it is 601. So price has come down. So YTM is higher than the coupon, price is at discount. And 679 GOI 2029, now YTM is lower than 679 at 640. The price of the bond is at a premium 102.55. So what I stated in English in the previous slide I have captured with live examples, not today, maybe 6 months back, live examples to give you the idea how this YTM and coupon will indicate whether a bond will trade at a discount or at a premium.
Sir, explain once again, sir.
Yeah, I explain once again. 563 is the coupon of the bond and YTM is 563. So what happens? YTM
what is 2026, 2033, 30 and 2029?
That I explained first itself how you give it do the namakaranam of the baby. 585 coupon, issuer GOI, 2030 tenor, and then maturity date 1/12/2030. So here that tenor is 2026 mein mature ho jayega, 2030 it will mature, and 2029 it will mature. So that is it.
Okay, sir.
Clear? Good.
Sir, can we say YTM as market rate of interest?
Perfect. Because market rate
Present value. Present value.
The present value, yes. Present value is reflected in the price 100 or 98, 80 or 102.55. Corresponding YTM is reflected in the YTM number 563 or 601 or 640. Beautiful.
Sir, formula to calculate YTM is formula for calculating.
That is what I said. There is no formula YTM equal to. There is only one formula. Price is equal to cash flow 1/1 plus R, cash flow 2/1 plus R square. And it is this R in that equation that is the YTM.
Okay, sir.
It's an iterative process. If you read about what is IRR, you will understand very clearly.
Sir, from where we will get cash 1, cash 2, cash 3?
If I say 679 Government of India 2029, what is the cash flow one? Half yearly coupon, how much it is? 679, half of 679. For 100 rupees, it will give you 6 rupees 79 paise as the interest. So 3 rupee 30, how much? 35, 70, so 39. No, 39 and a half or whatever it is. Okay. That is the half yearly coupon.
Sir, suppose we are in the 2030.
Suppose we are in the 2030. That person, you please ask the question.
Suppose we are in the 2030. We lost that 100 minus 9.8, 98.8. That the bank is losing that 1.2 or 2.2
correct
of loss. This is the loss that the banks are making investment in its bond.
Correct.
Because of the interest rate hike.
Correct.
Okay. In case of suppose we are in the 2029, we are getting 2.55. What we expected against 100 rupees. The 2.55 is the profit
for the seller.
For the investment, for the bank's investment against the rate of interest which is reducing.
Correct. Whatever you said now is correct.
Okay.
See, this is precisely the point. You don't worry too much about the other person's profit and other person's loss, and you don't start computing your P&L also now. There is still time. You need to discuss a lot of things to work out the P&L part. There is a lot of time available. Okay. At this moment, you just understand this equation or the balance, the seesaw. When price comes down, YTM goes up. And when YTM comes down, price goes up. So coupon is 563, YTM is 563, price will be 100. Coupon is 563, YTM is 590, this price will come down. Coupon is 563, YTM is 5, this will go above 100. That's all. So that three situations I have given 3 different bonds for you to understand better. That's all. I could have given the same 563 also. Then it becomes too mundane. So I thought it would be more interesting if I give 3 different bonds. You'll be able to relate better. Okay.
So in the previous equation, we are going to find that YTM or from
correct.
that cash inflows. That's it.
For examination, but there will be no question about calculating YTM. All these application questions only will come. So that is why you understand the concept. Don't go into the calculation. That anyway, in ABM, you are going to work your head on calculating the annuity factor and all that. 1 plus R by 100 factor you are going to work out in your ABM. So why we should spend time on that now? That is the point I am asking.
So cash fund flows is half yearly interest. So 3
Half
rupees
yearly interest,
something
yes.
by 1 plus R.
Yes.
That is that quarter.
Yes.
What is that?
Yes.
Current value.
Yes. 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 So this is what you should understand in your mind very clearly. When price risk is against you, reinvestment risk is in your favor. That we have already explained earlier. So now we will come to duration at 11:30. Till then, let us take a break.
Sir, when price risk is against you, reinvestment is your favor. Actually, can you elaborate?
I will elaborate at 11:30, please. I will elaborate.
Reinvestment risk once again, sir.
When we discuss duration, it will be again revised. That is why I put duration, please.
Sir, could you please explain the question that was posted yesterday WhatsApp group, sir?
Group question, you come to me on a one-to-one basis on WhatsApp or telephone, I will explain.
Okay, sir.
Kindly share your mobile number.
It's the break and wait.
It is there in the group. These kind of things, please. You see the group, my name is there. I am there on the group.
Okay, sir.
क्यों जल्दी कर रहे हो? 15 मिनट में आपको